In 1994, a financial planner named William Bengen sat down with a yellow legal pad and a stack of historical market data going back to 1926. He was trying to answer one question that nobody had ever actually solved with real numbers. How much can a retiree withdraw from a portfolio each year without running out of money before they die? He crunched the numbers for every 30-year retirement window in the historical record. Best case, worst case, average case. He looked at the Great Depression, he looked at the 1970s stagflation, he looked at every bear market and every bull market, and after months of work, he published a paper that became the single most influential piece of financial planning research in history. His conclusion, 4%. Withdraw 4% of your portfolio in year one of retirement, adjust for inflation each year after that, and you will never run out of money across any 30-year period in the historical record. The 4% rule was born. Financial advisors embraced it immediately. It was clean. It was simple. It was backed by data. Within a decade, it was baked into every retirement calculator, every financial plan, every spreadsheet that every certified financial planner produced for every client in America. If you ask your advisor today how much you need to retire, they will almost certainly divide your target annual spending by 0.04, hand you a number, and tell you that is your finish line. The problem is that William Bengen himself no longer believes the 4% rule is safe. In 2021, he revised his estimate downward to 4.5% given current conditions. And many researchers who have updated his work using modern data now say the truly safe withdrawal rate going forward might be as low as 2.7%, not 4%. 2.7%. Here is why that matters in a way that should stop you cold. If you were planning to retire on $100,000 a year and you believed the 4% rule, you needed $2.5 million. At 2.7%, you need $3.7 million. That is a $1.2 million gap, a gap that nobody told you was there, a gap that millions of people are currently walking toward, completely unaware, with the full confidence that their math is right. My name is Tom, and I've spent the last 4 years reading the research papers that financial advisors don't read, the academic journals that don't get covered on CNBC, the actuarial tables that insurance companies use when they're pricing annuities. Because insurance companies are not optimists. They are in the business of being right about how long people live and how markets perform, and they cannot afford to be wrong. And what those tables tell you about the future of retirement in America is genuinely alarming in ways that go far beyond a percentage point or two. If you are someone who has been told to max your 401k, buy index funds, wait for compound interest to do its thing, and plan for the 4% rule, and you're starting to feel like that plan is missing something but you can't figure out what, this video is for you. By the time we're done, you will understand exactly why the 4% rule is a relic of a world that no longer exists. You will understand the 3 structural changes since 1994 that have quietly destroyed its assumptions. You will understand why the conventional retirement plan is not conservative. It is actually one of the riskiest financial strategies most people will ever execute. And you will understand what the actual math says you should do differently, not as a scare tactic, but as a precise correction to an engineering flaw in a plan that millions of people are counting on. Let me start with a metaphor that I think captures what is actually happening. Imagine you are an engineer designing a bridge. You study every bridge built in the last 100 years. You analyze the forces, the materials, the load distributions. You publish a specification. This bridge design can safely hold 40 tons. It is backed by data. It is mathematically sound. For 50 years, contractors build bridges using your specification, and everything works fine. But here's the thing. Your specification assumes certain steel alloys, certain concrete densities, certain environmental conditions. And over time, without anyone formally announcing it, the steel mills changed their processes. The aggregate suppliers changed their mixtures. The climate changed the freeze-thaw cycles the bridges face each winter. Every single one of your inputs changed. The bridge still looks the same on paper. Engineers are still using your formula, but the actual safe load is now 28 tons. Nobody updated the spec. That is the 4% rule in 2026. The inputs have changed dramatically. The formula has not been updated. And bridges built to the old spec are quietly failing all across America in the form of retirement accounts that look fine on paper, but will run out of money before their owners do. So let me show you the 3 specific inputs that changed. The first is interest rates over the historical baseline. When Benjan ran his analysis, he was looking at a world where bonds yielded 5%, 6%, 7%, sometimes more. A traditional retirement portfolio is 60% stocks and 40% bonds. The bond allocation was never just there for stability. It was there to generate real income. When retirees in 1975 or 1985 pulled money out of their portfolio during a down year for stocks, their bonds were throwing off substantial yield. The stocks would recover, the bonds would pay, the portfolio could survive. From 1994 to 2022, the Federal Reserve engineered a secular decline in interest rates that took the 10-year Treasury from about 8% all the way down to 0.5% during the pandemic. 40% of your traditional retirement portfolio went from generating real income to generating almost nothing. The 4% rule assumed a world where the fixed income half of your portfolio was actually doing work. For most of the last 20 years, it was not. Now rates have risen again. The 10-year Treasury is back above 4%. That part of the picture looks better. But here's the trap. The portfolios that were built during the zero-rate era, the people who bought bonds at 0.5% yields, are still holding those bonds at prices far below what they paid. Rising rates help new buyers. They devastated existing bondholders. And the people who are retiring right now in 2026 with portfolios built over the last decade are in many cases sitting on a bond allocation that is underwater, generating lower yields than they planned for, and worth less than the face value they're counting on. The second input that changed is valuation. Benjan's historical data included many different starting valuations for the stock market: high PE ratios, low PE ratios, everything in between. But here is what the data consistently shows. The single most powerful predictor of long-term forward returns from stocks is the starting valuation. When you start investing at low valuations, forward returns are high. When you start investing at high valuations, forward returns are low. Right now, the S&P 500 is trading at a cyclically adjusted price-to-earnings ratio, what researchers call the CAPE ratio, of roughly 34. The historical average is around 17. We are at 2 times the historical average valuation. The last time CAPE was this high for an extended period was right before the dot-com crash. The time before that was 1929. This matters directly for the 4% rule because when Robert Shiller, the Nobel Prize-winning economist who popularized the CAPE ratio, analyzed safe withdrawal rates based on starting valuations, he found a disturbing relationship. At CAPE ratios above 25, the historical safe withdrawal rate drops to approximately 3.3%. At CAPE above 30, it drops below 3%. The research is not saying the market is going to crash. It is saying that when you begin withdrawing from a portfolio at elevated valuations, there is a higher probability of encountering a bad sequence of returns early in retirement. And that, as we will discuss in a moment, is the thing that actually kills retirement plans. The third input that changed is longevity. Benjan designed the 4% rule for a 30-year retirement. He assumed most people would retire at 65 and live to 95 at the outside. In 1994, that was a reasonable outer boundary. Life expectancy at birth in the United States was around 75 years. A 65-year-old planning for 30 years was planning generously. Today, a 65-year-old American woman has a roughly 50% chance of living past 87. She has about a 25% chance of living past 92. And that is a statistical average. If you are healthy, a non-smoker, have above-average access to healthcare, and have the family genetics of someone who tends to make it to their late 80s or 90s, you are not the average. You are in the upper half of the distribution, and your retirement might last 35 years, 40 years, maybe more. Run the 4% rule over 40 years with a starting CAPE of 34 and a bond portfolio that spent the last decade yielding near zero. And the historical survival rate of your portfolio drops from 95% to something considerably less comfortable. There is a name for this in actuarial science. It is called longevity risk. And it is the risk that most people's retirement plans are almost entirely blind to, because every chart that gets shown in a financial planning meeting ends at 30 years of retirement. Not because that is realistic, but because it is where the math still looks good. Now, let me tell you about a concept that most people have never heard of, and that I believe is the single most important and underexplained idea in all of retirement planning. It is called sequence of returns risk, and understanding it will completely change how you think about what you are actually building. Here's the setup. Two people retire on the same day with the same $1 million portfolio. Same asset allocation, same 4% withdrawal, $40,000 per year. Same average annual return over a 20-year retirement, 7%. Person A encounters a bad market in the first 5 years of retirement, then a good market for the following 15. Person B encounters a good market in the first 5 years, then a bad market for the final 15. Same average return, same withdrawal rate, same starting portfolio. Person A runs out of money completely at year 18. Person B retires with $1.8 million still in the account. Same numbers. Completely opposite outcomes, because when you are withdrawing from a portfolio, the order of the returns is not a detail, it is everything. Here is the arithmetic intuition. In year 1 of a bad market, your $1 million drops to $800,000. You still withdraw $40,000. You are now down to $760,000. In year 2, another bad year. Portfolio drops another 20%. You are at $608,000. You withdraw $40,000 again. You are at $568,000. You are now at 56% of your original portfolio, and you have only been retired 2 years. Even if the market goes straight up at 10% per year for the next 20 years, the math can no longer save you. You are withdrawing $40,000 a year from a shrinking base, and the compound growth never gets the traction it needs because the base it is compounding from was destroyed in the first few years. The person who retired into a bull market did not experience this. Their portfolio grew in the first 5 years even while they were withdrawing. The base they were compounding from was larger than when they started. Their withdrawals became proportionally smaller relative to the total portfolio. The arithmetic worked in their favor. This is why the sequence of returns is lethal in retirement, in a way that it simply is not during accumulation. When you are accumulating wealth, a market crash is a buying opportunity. You are adding money, not removing it. The lower prices mean your contributions buy more shares. The eventual recovery amplifies your gains. The sequence of crashes and recoveries does not destroy you. It helps you. The math runs in your favor. In retirement, the math runs in reverse. You are now a net seller every month for the rest of your life. The sequence of prices at which you sell matters enormously, and you have zero control over it. Let me introduce you to someone. We will call him Robert. Robert is 64. He spent 35 years in supply chain management, never made spectacular money, topped out at around $95,000 a year. But he was disciplined. He maxed his 401k for most of his career, lived modestly, did not carry consumer debt. By 64, he has $1.3 million in his retirement accounts. He has run the calculator on every mainstream retirement planning website. The consensus answer, you can withdraw $52,000 a year. Add your Social Security of $2,200 a month, and you have roughly $78,000 in annual income. For Robert's lifestyle, that is plenty. He's retiring at 65. He tells his wife they're going to be fine. What Robert did not model is that he is retiring into a market priced at 34 times cyclically adjusted earnings. He did not model that the bond portion of his portfolio, 40% of his allocation, has an average yield of 2.1% because he built it during the low-rate era. He did not model what happens to his plan if the first 3 years of his retirement look like 2000 to 2002. In that period, the S&P 500 fell 49%. His $780,000 stock allocation becomes $397,800. He has withdrawn $156,000 in those 3 years. He is sitting on $553,800 in stocks, plus roughly $530,000 in bonds, a total of about $1,083,000. He is at 83% of his starting portfolio after 3 years. which sounds okay until you realize the recovery he needs to get whole again is going to take at least 5 more years of positive returns before before he has recovered to where he started. During which time he continues withdrawing $52,000 per year plus the inflation adjustments he owes himself. Robert is not going to run out of money by 75. He is probably going to be fine until 80. But at 83, 84, the math gets uncomfortable. At 87, if he is still alive and his wife needs long-term care that Medicare does not fully cover, the plan starts falling apart. Not catastrophically, not dramatically, but with the slow, grinding humiliation of someone who did everything right and still ended up rationing heat in a house he thought he owned outright. Robert is not a failure. Robert is a statistic. And he is going to be joined by millions of people in the next decade who executed the standard retirement plan with diligence and discipline, and still ended up discovering in their early 80s that the math was never quite right. Now, I want to talk about something that I think is even more important than the 4% rule, and it is something nobody in the mainstream financial planning industry will say out loud, because it cuts directly against their business model. The concept of a retirement number, a fixed sum you need to accumulate before you can retire, is a fundamentally wrong way to think about financial independence. Let me explain why. When you ask a financial planner how much you need to retire, they build a model that assumes a rate of return, an inflation rate, a spending level, and a time horizon. They plug those into a spreadsheet and produce a number: $2.5 million, $3.1 million, $4.2 million, and that number becomes your goal, your finish line, your definition of success. The problem is that the model assumes all of its inputs are knowable in advance and reasonably stable. It assumes that 7% annual returns are a reasonable expectation. It assumes 2.5% inflation. It assumes your spending stays relatively flat. It assumes you will live for exactly 30 years. None of those assumptions are stable. All of them are subject to variance that the model treats as noise, but that in practice is the entire ballgame. What you actually need is not a retirement number. What you need is a retirement system. And a system is fundamentally different from a number in the same way that knowing your blood pressure reading is different from having a healthy cardiovascular system. The number is a snapshot. The system is what determines whether the snapshot is accurate and what actually happens over time. Here is what a retirement system looks like versus a retirement number. A retirement number says, accumulate $2.5 million, then withdraw $100,000 per year, and you are done thinking about money. A retirement system says, build multiple income streams that are not all correlated to the same risk factors. Manage the sequence of your withdrawals based on actual market conditions, not a fixed rule. Maintain flexibility in spending rather than locking in a fixed withdrawal rate. Hold a buffer of liquid, non-market assets that allows you to avoid selling equities during downturns. Continuously reassess your allocation, not based on your age, but based on the specific conditions of the market at the time you need to sell. The difference between these two approaches is the difference between planning for average outcomes and planning for the full distribution of outcomes you might actually experience. The financial planning industry sells you the number because it is simple, it is quantifiable, it gives them a clear mandate and a clear success metric, and it produces the right behavioral outcomes during accumulation. If you believe your finish line is $2.5 million, you will save and invest diligently. That part of the advice is correct. The accumulation behavior the number drives is genuinely good behavior. The problem is what happens when you arrive at the number and discover that the assumptions baked into it do not match the world you are actually retiring into. Let me show you what the system looks like in practice, with real mechanics and real numbers. The first component of a retirement system is what I call a dynamic withdrawal strategy. Instead of taking a fixed 4% regardless of market conditions, you modulate your withdrawals based on actual portfolio performance and market valuations. In years when the market is up significantly, you take your full planned withdrawal, plus you bank some additional reserves. In years when the market is down more than 10%, you reduce your spending by 10 to 15% where possible and avoid selling depressed equities by drawing from your cash buffer instead. This sounds simple, but it requires something that a fixed withdrawal rule does not: genuine flexibility in your spending. Most retirees think they have that flexibility, but they do not. Their spending is structured: mortgage or property taxes, insurance premiums, medical costs that increase with age and are largely non-discretionary. The 20% of retirement spending that is actually discretionary, travel, restaurants, gifts to children, is not enough to absorb a meaningful spending cut during a bad market without feeling like a real deprivation. This is why the cash buffer component is not optional. It is load-bearing. You need between 18 and 36 months of living expenses and instruments that do not lose value when the market falls. Not a savings account earning 1%, a high-yield savings account, short-duration treasury bills, or a money market fund. This is not your emergency fund. This is your market buffer. It exists for one specific purpose: to allow you to leave your equity portfolio completely alone during the first 2 to 3 years of a bear market, buying it time to recover without forcing you to sell at the bottom. The math on why this matters is striking. If you had retired in January 2000 with $1 million and you could have simply not touched your equity portfolio for 3 years, living off a cash buffer, and then resumed normal withdrawals in 2003 when the recovery was underway, your portfolio survival probability would have increased dramatically compared to someone who was forced to sell into the crash each month to meet expenses. The second component is income diversification outside the portfolio. The 4% rule assumes you are funding 100% of your retirement from a single portfolio. That is the most fragile possible architecture. Every additional income stream that is not correlated to your portfolio's performance reduces your withdrawal rate requirement and increases your plan's resilience. Social Security is the most obvious one. Delayed claiming from 62 to 70 increases your monthly benefit by approximately 77% for most Americans. That is not a trivial number. If your expected Social Security at 62 is $1,800 per month, delaying to 70 converts that to approximately $3,186 per month. That is $1,386 per month more every month for the rest of your life, guaranteed by the federal government and inflation adjusted. If you live to 85, the cumulative difference is over $228,000. And every dollar of that guaranteed income is a dollar you do not need your portfolio to produce, which directly and mechanically reduces your sequence of returns exposure. If your total retirement spending is $80,000 per year and Social Security covers $38,000 of that, you only need your portfolio to produce $42,000. Your effective withdrawal rate on a $1.5 million portfolio is now 2.8%. The sequence of returns math gets dramatically safer at 2.8% than at 5.3%. The decision to claim Social Security early is almost never optimal in the absence of a specific health condition or financial emergency. But millions of Americans claim at 62 because they are anxious to get something out of a system they do not trust, and because the financial planning advice they have received does not emphasize the magnitude of the delayed claiming benefit with sufficient clarity. They take $1,800 a month starting at 62 when they could have taken $3,186 a month starting at 70, and they reduce their lifetime income by potentially hundreds of thousands of dollars in exchange for 8 additional years of a smaller check. Rental income from real estate, part-time consulting, or business income during the early years of retirement, royalties, annuities used strategically for base income coverage. All of these reduce portfolio dependence and sequence of returns risk. The goal is not to maximize income. The goal is to create income streams that do not all fail at the same time. The third component is what I call valuation-aware asset allocation. Traditional financial planning tells you to shift your portfolio toward bonds as you age. The conventional wisdom is a rule of thumb like hold your age in bonds. If you are 60, hold 60% bonds. This made reasonable sense when bonds yielded 6% and acted as a genuine counterweight to equity volatility. It makes significantly less sense when bonds yield 2% and their own prices are highly sensitive to interest rate moves. The question of how to allocate your retirement portfolio should not be driven primarily by your age. It should be driven primarily by 3 variables: the current valuation of equities, the current yield on bonds, and your specific cash flow needs. These are not fixed inputs. They change year to year, and they should change your allocation year to year. At a CAPE ratio of 34, forward 10-year equity returns are historically below average. That does not mean sell everything and go to cash. It means you should have a higher allocation to assets that do not depend on multiple expansion for their returns. Specifically, dividend-paying value stocks rather than growth stocks, international equities and markets with lower starting valuations, real assets including REITs and commodities that provide genuine inflation hedging, and short-duration fixed income that does not carry significant interest rate risk. If you are 62 and building your retirement portfolio right now, the standard 60/40 of a broad S&P 500 index fund and an intermediate term bond fund is not your friend. Not because either asset class is bad in absolute terms, but because both are currently expensive by historical standards in ways that reduce their expected forward returns precisely when you are about to start drawing from them. Let me bring all of this back to concrete action steps. Because I know some of you are sitting here thinking this is alarming. But what do I actually change? Here is the protocol. Step 1. Do not use the 4% rule as your planning target. Use 3% to 3.25% as your safe withdrawal rate if you are planning a 35-year or longer retirement starting at current market valuations. This means your target retirement number is materially higher than a standard calculator told you. If you need $80,000 per year and Social Security covers $35,000, you need $45,000 from your portfolio. At 3.1%, your portfolio target is $1.45 million. At 4%, it was $1.125 million. The difference is $325,000, and it may represent the difference between running out of money at 83 versus never running out of money. Step 2. Optimize your Social Security claiming strategy before you make any other financial decision about retirement. Run the break-even analysis. If you are in reasonable health and your family genetics suggest you will live past your late 70s, the numbers almost always favor delayed claiming. This is free money that requires no investment skill and no market timing. Do not leave it on the table because you are anxious about the system or because $1,800 a month right now sounds better than $3,186 a month in 8 years. Step 3. Build your cash buffer before you retire, not after. 2 years of living expenses in instruments that do not decline with the stock market. This buffer is not counted as part of your retirement portfolio for withdrawal rate calculation purposes. It is insurance against sequence of returns risk in the first 3 years of retirement, which is statistically the most dangerous window. Fund it from bonds you are going to hold anyway. Reframe it not as cash sitting idle, but as the structural component that allows your equities to compound without being disrupted by your need for income. Step 4. Diversify your income before you retire. If your entire retirement income plan is your portfolio plus Social Security, that is only 2 income streams. Look seriously at what else is available to you. Can you work part-time in your field for the first 5 years of retirement at a rate that covers even 30% of your expenses? That changes your withdrawal requirements enormously during the highest risk window. Do you have any assets you could convert to income-generating properties? Are there business or consulting opportunities that could produce meaningful income without full-time commitment? The goal is not to work forever. The goal is to protect the first 5 years of your portfolio from being the years that determine whether your plan survives. Step 5. Revisit your allocation with a valuation framework, not an age framework. At current equity valuations, a retirement portfolio that starts heavily weighted toward the same 7 tech stocks driving the S&P 500 index is carrying concentrated valuation risk that the index label obscures. Consider equal weight allocations, international equities trading at lower valuations, dividend-focused funds, and real assets as partial replacements for standard U.S. large-cap growth exposure. You are not trying to beat the market. You are trying to reduce the probability of a devastating first 5-year sequence precisely at the moment you most need the portfolio to hold together. Now let me address the thing that I think matters most, and it is not mathematical. It is psychological. The deepest problem with retirement planning in America is not that people do not save enough, though many do not. It is not that they pick the wrong funds, though many do. It is that the way retirement is sold to them creates a fundamentally passive relationship to their own financial future. You are told, pick a target date fund, contribute automatically, let time do the work, trust the process. For 30 years of accumulation, that is largely reasonable advice. The problem is that it trains people to be non-participants. It trains them to not read the actuarial tables. It trains them to not understand what the CAPE ratio means for their expected forward returns. It trains them to accept the 4% rule as a physical law rather than a historically derived estimate built on assumptions that are no longer valid. And then they arrive at retirement having followed all the rules and discovered they are playing a game that has changed around them while they were sitting passively in their target date fund, trusting the process. The people who are going to be okay in retirement over the next 20 years are not necessarily the ones who accumulated the most money. They are the ones who treat their financial plan as a living document, not a destination, who understand the mechanisms well enough to adjust when the inputs change, who have built real flexibility into their spending and real diversification into their income rather than betting everything on one number, surviving one formula for 35 years. I want to tell you about a couple I know. We will call them Claire and David, both early 60s. Both retired about 3 years ago with $1.6 million, combined between their 401k accounts and a brokerage account Claire had been managing for 20 years. By the 4% rule, they had enough to spend $64,000 a year. Their actual spending runs closer to $75,000, but they figured the Social Security they would eventually claim would close the gap, and they had buffer built in from a small rental property David owned that generated about $12,000 a year net. What they did right, they did not claim Social Security the day they retired. They are letting it run until David turns 70. They have 3 years of living expenses and T-bills. Their rental property income is paying roughly 16% of their annual spending, reducing portfolio withdrawal requirements considerably. Claire shifted a significant portion of her equity allocation 2 years ago from an S&P 500 index into a value-tilted international fund and a dividend-focused domestic fund. Not because she was trying to time the market, but because she read Robert Shiller's work and was not comfortable being heavily concentrated in growth stocks priced at 30-plus times earnings just as she was about to start selling. They are not rich, they are not investors by profession, but they understand the mechanisms. They understand why the sequence of returns is dangerous and how the cash buffer diffuses it. They understand that Social Security delayed is Social Security monetized, and they understand that the inputs the 4% rule was built on have changed. So they have adjusted their planning to reflect a world with lower forward returns and higher longevity than 1994. That is not genius. That is just understanding the game you are playing. Here is what I want to leave you with. The retirement planning industry has, for 30 years, been selling a profoundly compelling product. Save diligently, diversify, trust compound interest, retire to the 4% rule. It is compelling because it is largely correct during accumulation and because it produces the right behaviors. Regular savings, long-term thinking, the diversification across asset classes. The accumulation advice is basically right. The distribution advice, the framework for how you actually draw down the wealth you accumulate, is built on assumptions that have not been updated in 3 decades and that are dangerously wrong in a world of elevated valuations, changing interest rate regimes, and significantly extended lifespans. The most important thing I can tell you is this. The fact that most financial plans are built on flawed assumptions does not mean your retirement is doomed. It means you need to understand the assumptions and update them. The math is not working against you. The math is neutral. What is working against you is the comfortable fiction that a rule of thumb from 1994 is a permanent law of financial physics. Understand sequence of returns risk. It is not a theoretical concern. It is the specific mechanism that destroys retirement plans, and it is entirely manageable with the right structural choices before you retire. Build your cash buffer. It is the single highest impact structural decision a near retiree can make, and it costs almost nothing relative to the protection it provides. Optimize Social Security claiming. It is the one guaranteed inflation-adjusted income source in your plan, and most people claim it at a time and in a way that leaves substantial lifetime income on the table. Diversify your income across streams that do not all fail at the same time. Portfolio plus Social Security is 2 streams. 2 streams failing simultaneously is not a remote scenario. It is what happens in the first 2 years of a bear market if you retire at exactly the wrong moment. And finally, treat your financial plan as a system to manage, not a number to reach. The bridge engineers who built to the old spec were not negligent. They were working with the best information they had. But when the materials changed, the engineers who updated their calculations built bridges that held. The ones who trusted the old spec built bridges that did not. Your retirement plan is a bridge you are building right now. The materials have changed. The calculations need to be updated. I am not here to tell you that you have done everything wrong. Most people who are watching this have done a great deal right. They saved. They invested. They showed patience and discipline during bear markets when everything told them to sell. That matters enormously, and it is not nothing. I am here to tell you that the last mile of the race has different terrain than the first 40 years. And the map most people are carrying was drawn in 1994 for a different landscape. Update the map, adjust the inputs, build the system. Because the people who understand the real mechanics of retirement distribution, not the simplified version sold in a 30-second advisor consultation, are going to retire into genuine financial freedom. The people who don't are going to retire into a slow, confusing, quietly humiliating arithmetic problem that they spent their entire working lives trying to avoid. That is the retirement math they taught you. And now you know why it's wrong. Subscribe if this helped you see something clearly that was blurry before. Drop a comment and tell me which piece of this, the sequence of returns, the Social Security math, the CAPE ratio implications, was the part nobody ever explained to you. Because I want to know where the gap is, and that gap is where the next video starts. See you there.